Picture a quiet trading floor after hours. The monitors are dim, the news feed is silent, and there's only one thing moving, a simple line crawling across a chart. It isn't a stock price. It's time since the yield curve inverted. Someone left a note taped to the screen. 1929, 2008, then scribbled in red underneath, 18 months. The question isn't whether the line will end at a headline, it's whether we're already inside the crash window, right now, counting down without realizing it. If you've never heard of the 18-month pattern, don't worry. It's finance's most boring alarm clock. Until it isn't. The pattern is simple. When short-term interest rates jump above long-term rates, the bond market is telling you the near future looks worse than the distant future. That flip, an inversion, has preceded every major recession in the modern era. Not some of them. All of them. And the lag between that flip and the real economy breaking? Roughly a year and a half. Long enough for everyone to relax. Short enough that the damage is still loading while we celebrate the soft landing. But patterns aren't prophecies, they're pressure gauges. So let's test the gauge. In the late 1920s, America was a party, easy credit, margin loans, and the first mass market for stocks. In early 1928, the curve flattened and inverted as the Fed tightened 18 months later, almost to the month, Black Tuesday. The crash didn't come because a line inverted. It came because the inversion captured something hidden. Credit was already tightening, leverage was already frothing, and confidence was already brittle. The 18 months were the fuse. Fast forward to the mid-2000s. The curve inverted in 2006. Housing was levitating, structured products were selling themselves, and banks were funding long, risky assets with short, cheap money. Again, the clock started. 18 months later, we were watching money market funds break the buck, listening to CEOs insist their firms were fine as they rushed to merge before Monday, and learning what counterparty risk feels like when it goes from theory to price. The clock wasn't magic. It was the time it took for resets to reset, for teaser rates to drop their mask, for liquidity to walk out of the room. Now for the uncomfortable part. The curve inverted again, deeply, and it stayed inverted long enough to matter. That's the setup for our 18-month pattern 2.0, but the economy is not a rerun. It's a sequel with new characters and faster editing, which means if there is a crash window, it won't open the way it did last time. Start with the balance sheets that lived on zero. Households locked in low-rate mortgages. That's good. But corporate America? A huge chunk of debt was issued with floating coupons or short maturities. Those maturities are rolling now. CFOs who bragged about cheap leverage in 2021 are whispering about interest coverage in 2025. Each refinance is a haircut to earnings, a pause on hiring, a delay on capex, and quietly, a decision to cut the weak product, the borderline location, the marginal headcount. Commercial real estate is the bridge where credit meets gravity. Buildings were valued on cap rates born in a near-zero world. Now cap rates are up, valuations are down, and the debt attached to those buildings hasn't shrunk. A mall that penciled at 3.5% no longer does at 6%. A downtown tower that lost tenants doesn't refinance at yesterday's loan-to-value. And the banks that hold those loans? They aren't villains. They're bound by math. You can pretend a bond is worth par if you never sell it. You can't pretend a building is fine if the rent doesn't cover the note. Meanwhile, the quiet machine that makes modern markets look smooth, passive flows, collateral chains, and daily liquidity works great at cruising altitude. It's in descent that you learn where the exits are. When volatility rises, risk managers reduce exposure by rule, not by mood. When spreads widen, models say less, not maybe. And when everyone holds the same ETF basket because it's safe, selling looks like a chorus, not a whisper. The 18-month lag used to reflect paperwork and mail. Today, it reflects calendar-based refinances, covenant tests, budget cycles, and the simple fact that fear travels at fiber speed. Okay, you say, but unemployment is low and consumers are still spending. True. Remember the lag. Households can look fine while their costs of money, credit cards, car loans, small biz lines, ratchet up in the background. Delinquencies start at the edges. Subprime auto, buy now, pay later, private student loans. Then it crawls inward. A diner owner on Main Street renews her line of credit at double the rate, cancels the breakfast shift, and tells 2 longtime employees she can only offer weekends. They don't show up in the data for a while, but they show up in the till tonight. Cities feel it next. Higher yields mean higher debt service. Deferred maintenance stays deferred. Hiring freezes save payroll but cost response times. Pension funds lean harder into alternative yield, which works until alternatives go illiquid right when redemptions arrive. Remember, a promise to pay daily backed by assets that trade weekly is fine, until a headline makes weekly feel like never. Banks? They're the usual suspects, but they're not the only suspects. The last crisis taught regulators to bolt down capital, stress test, and raise liquidity buffers. That helps, but risk migrates. Private credit funds lend where banks won't. Shadow banks warehouse risks that don't show up on standard reports. Money market funds herd into the safest paper until safe means the same issuer, the same maturity, the same everyone is there. A rate shock doesn't have to kill a bank to cause pain. It can freeze a county, a landlord, a school district, a supplier, a startup. Each too small to trend, large enough to ripple. So are we already in the crash window? Here's how you can tell without predicting dates. First, watch the labor market for quality, not just quantity. Are full-time jobs drifting toward part-time? Are hours cut before headcount? Are job openings and services fading while goods employment stalls? Second, watch credit spreads. Those are prices for fear. They widen early, then pretend to tighten, then widen for real. Third, watch refinancing calendars. When the maturity wall moves from talked about to this quarter, you find out who had a plan and who had a prayer. There's a psychological gear shift too. Late in the cycle, optimism sounds reasonable. Soft landing, immigration will expand labor supply, productivity is picking up. Those can all be true, and still get overwhelmed by simple arithmetic. If your interest expense doubles, your cushion shrinks. If your margin shrinks, your ability to absorb a shock disappears. If the shock hits while you're cutting, you don't bend, you snap. The point isn't to doom scroll your portfolio, it's to understand what an 18-month pattern actually measures. Not fate, but friction. After an inversion, the cost of money rises faster than the price of optimism can adjust. Contracts written in a different world meet cash flows from this one. That meeting is the crash window. What do you do with that knowledge? You slow your decisions and shorten your promises. You treat cash flow as king and duration as a risk, not a brag. If you're a CFO, you refinance early even if it bruises your ego because the rate isn't perfect. If you're a landlord, you look at debt service coverage the way a pilot looks at fuel. If you're a household, you trade clever for boring. Fixed beats, floating, savings beats stretch, emergency fund beats, I'll sell something if I have to. And if you're an investor, you stop arguing with the clock. Tops are processes, not moments. Downturns are narratives, not numbers. People will tell you this time is different because the sectors differ, the slogans differ, the villains differ. But the mechanics of stress do not. Cash becomes precious, duration becomes dangerous, leverage becomes fatal. The 18-month pattern 2.0 simply recognizes how much faster narrative can travel now and how much slower liabilities change. Back on that empty trading floor, the line on the screen reaches the edge. No fireworks, no siren, just a quiet realization. Windows don't announce themselves. They open. The question that matters isn't whether we can name the day. It's whether we can see the structure, a world built on cheap money, relearning the price of time. When that lesson arrives, it doesn't knock. It walks through everything, banks, budgets, buildings, bonuses, and asks one question. Can you pay at this rate? History's answer has been consistent. After the inversion comes the wait. After the wait comes the test. The test doesn't care about hashtags or press conferences. It cares about cash. If you align your life, your business, your city to that reality before everyone else does, you're not predicting a crash. You're refusing to be its collateral. The window may already be open. The choice is whether you're standing in it or stepping back, checking your footing, and closing the gaps you can control while there's still time.